Thank you everyone for joining us this evening for a talk by Professor Sanjeev Das. Uh, Warm welcome to you, Professor, and to all the audience members as well. Let me just briefly introduce Professor Das. He is presently Brilliant and Janice Study Professor of Finance and Data Science at Sandhya University. He's in the Data School of Business, and he's also an Emerson Scholar at AWS. Previously, he was associated with Harvard Business School and also UC Berkeley. He holds a postgraduate degree in finance and PhD from New York University. He's in computer science, from UC Berkeley, and he's also an alumnus of this particular institute from Ahmedabad. Prior to that, he had done his BCom in accounting and economics from the University of Bombay. He is also very senior editor in the Journal of Investment Management. He is an associate editor of Management Science and other academic journals. He is also present in the FSC board of the Journal of Financial Data Sciences. Prior to his role as an academic, he was associated as a vice president at Citibank. His present research interests include portfolio theory, wealth management, machine learning, financial networks, derivative pricing models, modeling of default risk, systemic risk, venture capital. He has published several articles. He has also written a textbook on derivatives principles in practice, which is used quite extensively in classrooms. So with that brief introduction, let me just welcome Professor Das, and you can take it from here.
Thank you, Anirban. Appreciate very much the opportunity to speak to everyone today. And I graduated in 1984, so it's been 37 years now since I passed out of the institute. This work is joint work with Dan Ostrov, who's my colleague in the mathematics department, Deep Srivastav, who is an alumnus of the institute also, 1993, and Anand Radhakrishnan, who actually works for Franklin Templeton in the Hyderabad office. So it's sort of a India-US collaborative effort. Goal-based wealth management is something that's been talked about for quite a long time, but there was no mathematical framework for implementing it. And so we decided to sort of put that together and in fact, implement the whole thing. This is probably going to be rolled out in industry this year as well. So I'm going to sort of give you a basic outline. I'll talk a little bit about how the notion of risk changes when we're doing goal-based wealth management versus standard portfolio optimization. I'll go through a simple example of optimizing for single goals in a static model, and then with dynamic models, and then finally multiple goals with dynamic models. Okay, so we'll end up with a very large scale example where you can optimize a portfolio over 60 years, with very, very different types of goals, hundreds of goals and so on. So typical goals are, investor wants to have some amount for retirement. Multiple goals is where you want money in retirement for lots of different things. So you can have all these different goals. And, obviously everybody will have their laundry list of things that they want to make sure their portfolio gets. Now, obviously you cannot always get to all the goals. Markets are fairly unpredictable. And so, sometimes you might have a good outcome, sometimes you might have a bad outcome, but basically you want to maximize the probability of reaching as many goals as possible. Okay, so how do you sort of come up with an algorithm that does that and also allows people to use the same algorithm to define their goals and prioritize them? Okay, so that's sort of the general story of this work. There are 3 papers which had been distributed, and obviously you can go back to them and take a look at how they relate to the top. So what is portfolio risk? Basically, you study in your finance classes, it's the volatility of your portfolio, it's one standard deviation of returns and so on and so forth. But there's an idea too, which is what sort of goal-based investors care about, which is risk is the probability that you won't attain your financial goal. Okay, so it's a slightly different notion of risk. Obviously, it has some relationships to volatility as well, but it's a different kind of measure of risk, and it can also contradict the first measure of risk. Okay, so for example, a 20-year-old investing in bonds for retirement clearly has a low risk portfolio, but has a very high risk portfolio if you take idea 2 into account, because he's basically reducing the chances of reaching goals by not taking enough risk. Okay, so this is the trade-off that people have to worry about. Also, the second thing is that the probability that you won't attain your financial goals generally tends to be a more important concern for people who worry about not having enough money in retirement and so on and so forth. And so it takes a long-term view rather than a short-term view. Okay, so that's why it's sort of relevant. It also fits much better with sort of investors' view of the goals for the entire portfolio. People generally tend to find it easier to talk about that, especially lay people, rather than talk about sort of volatility in technical terms. Okay, so the language generally tends to be better. It's actually really good for robo-advising. In fact, if you look at most robo-advising platforms, they generally talk in terms of goals rather than in terms of risk-return trade-offs. Okay, so what we're going to do actually is not compromise. We're going to sort of implement idea 2, but still comply completely with idea 1 as well. Okay, so how do we sort of make an algorithm that's consistent for both measures of risk and optimal in terms of both measures of risk as well? Okay, so that's sort of the story of this work. Franklin sort of did a bunch of focus groups and surveys a few years back, which sort of started off this work, where we quickly realized that investors were not able to understand things like correlations. They weren't able to understand benchmarks, and so basically they were much more able to understand questions like percentage or likelihood of actually meeting your goals. Again, you can see that sort of fairly clearly in this slide. Now, so the goal really is going to be to allocate the portfolio so we optimize the property that the investor meets their financial goals. All right, so that's the overall thing. So we want to maximize the chance that you meet your goals. That's the objective function. But there's the other objective function, which is sort of trading off risk versus return. You want to minimize volatility, maximize return, and we want to have that in the back pocket as well. So let's start with some very basic ideas to set things in place. So you start out with some amount of wealth, W0. This is a standard Brownian motion process for wealth, which we have adopted widely in finance. So there's nothing new here. And your wealth grows at some rate mu, which is the mean growth rate. And it varies with some parameter sigma, which is the volatility of the portfolio. A Z here is a Gaussian shock, but the paper is completely general. So Z could be replaced by any kind of statistical distribution you like. All right, so this will translate into a random outcome for wealth over some horizon. And if you just rearrange this equation so that the mean of the portfolio is on the left and the risk is on the right, you basically have a return risk relationship. But that relates to goals over here because you want to go from W0 to WT, which is your goal as well. Okay, so we pack everything into one simple equation. And as an example, you can see that you could have a goal horizon of 10 years. You start out with 400,000, you have a target wealth of 500,000, and you want to get there with 80% probability. Okay. Now it turns out that you could have a whole collection of portfolios with different mu and different sigma. All right. So you could have sort of a locus of points. You could have high mu, high sigma, low mu, low sigma. All of them will sort of be able to get to this goal with some probability of 80%. So how do you specify 80% in this equation? You pick Z0, which is the cutoff under the normal distribution that corresponds to 80%. Once you have that fixed, you've got 400,000 here and 500,000 here, then you can play with pairs of mu and sigma and trace out a locus of points. So if you do that, you get a curve that's convex in shape, and you can see the sigma on this axis, mu on this axis. All the portfolios that have combinations of mu and sigma along this line satisfy that equation and therefore have an 80% chance of achieving the target. So you could choose to be high risk and achieve the target. You could choose low risk and have the same probability of achieving the target. Everything in the blue zone, if you can find portfolios here, they do better than 80%. Everything below the blue zone does worse than 80% in terms of goal probability. Okay. So yes.
Yeah, so we have a question from Bharti, who is a PhD student here. She's asking if assumption of geometric Brownian motion as the process, how valid is it if we are thinking about a long-term future, say for example 10 years or so?
Right. So we have some experiments in the second paper I gave out, which actually does work with T distributions and various other things. But there are two parts to that question. I think one is the normal distribution of the Brownian motion the right process to be using? And that, of course, is open to question. It turns out that you can, the results are not very sensitive to the choice of that. The second question is really, do we hold those parameters sort of constant over a very long horizon? And is that sort of a sensible thing to do? So one of the things we've done is we've tried to see what happens if you change the parameters over time in a regime switching model. So there's a paper on SSRN that you can take a look at. It won't be covered in today's talk, but we actually look at that, and that shows you how to sort of do the same analysis, but with regime switching between these things over time. And that sort of captures the long horizon. The short story of that is really that, in fact, that is not optimal, because now you're introducing another measure of risk, which is having to know which regime you're in. And if you think you're in regime, the good regime, when you're actually in the bad regime, you do actually much worse. And so unless you have a very high accuracy of being able to predict which regime you're currently in which case, obviously, you do better with a long run model like that. But it takes only a small amount of noise in the ability to pick which regime you're in to degrade the performance of those long-term portfolios quite substantially. Okay. All right. So, just to go back to this, if I change the goal probability to 90%, then I should be above this curve, to get a good portfolio and so on. Okay. So obviously, as I increase my required goal probability, the collection of portfolios gets smaller and smaller, because the ones above the curve are the ones that you need. Now you can overlay this on top of the efficient frontier. So I won't go into that. Obviously, everybody has taken Finance 101 and traced out efficient frontiers, and they know what they are. So notice that the 80% curve, anything on the green line above that 80% curve is an acceptable portfolio from the efficient frontier. And the nice thing about the efficient frontier is that you've sort of optimized the risk-return trade-off in tracing it out. So at least the portfolios on the green line are the best ones you want to use. The question now is, if I increase the goal probability from 80% and rotate this curve out, I can actually get a tangent point here to the efficient frontier that tells me that's the one that I should be using. And when I do that, it turns out I get up to, so the numbers I showed you before, it's 86.6%. Okay, so I can actually optimize the probability, the goal probability, by slowly rotating it out and getting to the tangent to the efficient frontier. And then there's one portfolio that's the best one for me, and I'm done. Now, if you're a different investor and you have a different sort of goal set with different goals, the 400,000 and 500,000 are different, then obviously this dark blue line will change. And then as you rotate it out and tangent to the efficient frontier, you'll get a slightly different portfolio. But the nice thing is that in current settings, financial advisors don't know where to place you on the efficient frontier. But the moment we ask questions about goals and we get the goal probability curve, we can then maximize it, and we know exactly what that investor wants. Okay, so the process today is, at least in the US, investors fill out a questionnaire. All it does is try to give the advisor a sense of whether it's a low, medium, or high risk investor. And if it is, then they just throw the person into one of low, medium, or high risk portfolios, and that's it. It's not customized to their goals or anything of that sort. It's only based on their risk preferences. So this is much more customizable to goals. Now, obviously, this is a geometric problem. We can convert this geometric problem into sort of a technical problem and actually solve for it in closed form. So we're going to do that. So I'm going to take this equation I showed you before and take the Z, that's the cutoff under the normal distribution, and bring it to the left, put everything else on the right. And what I know is that this is the equation that describes my goals. G is my goal, my initial wealth is over here. And I need to pick some mu and sigma combination on the efficient frontier, such that I get the maximum Z, because when I maximize Z, I maximize my goal probability. Okay, but there's a constraint, and the constraint is I can't just maximize Z. That is, I just can't go anywhere in that sigma space. I have to be on the efficient frontier. And this is the hyperbolic equation for the efficient frontier. And obviously, A, B, and C are very large parameter coefficient things that come from the Markowitz mean variance optimal problem. Okay, so that's the problem we want to solve. It turns out nobody solved this problem before. Okay, maximizing goal probably subject to satisfying also the Markowitz problem. And we were kind of surprised that the solution ended up, the Lagrangian solution ended up producing a cubic polynomial, which had 3 roots, 2 of which are negative and 1 is positive. And so we know it's a positive root that we want. And so let me trace out the whole thing for you. This is the efficient frontier, the hyperbola for the efficient frontier, with the sigma on the x-axis and mu on the y-axis. And A, B, and C are given by these terms. What are these terms, H and G? They are given by these expressions. And the fundamentals of these expressions are M which is the mean vector of returns for a large number of assets. O is a vector of ones, and sigma is a covariance matrix of return. So those are the standard inputs in the mean variance Markowitz problem. What we're going to do is maximize Z subject to this. It turns out you get this cubic polynomial, and the solution to this cubic polynomial we can actually get in closed form, and we have it over here. Okay, so we were able to solve this problem in closed form, which was kind of nice. So we extended Markowitz's work to goal probability settings, and this paper actually got sort of the best paper award for this particular solution. Okay, so that's the static problem. Okay, we've basically done one period optimization of the goal, subject to being on the efficient frontier. So the first thing you want to see here is that we've maximized the goal probability, which is our objective function, but we are also consistent with the most optimal mean variance trade-off that Markowitz optimization gives us, because we're only allowing us to maximize goal probability while remaining on the efficient frontier. That's very important. Okay, so idea one is remain on the efficient frontier. Idea two is maximize goal probability. And so both the things have now been married together into one optimization problem. So the next step is we want to do this over time. So now we are in the dynamic setting. And in the dynamic setting, what we want to do is, let's just start with one single goal. Okay. And what people have done in the past is they've maximized utility. We're not maximizing utility anymore because practitioners have basically found it's kind of not really helpful. You can't go and ask somebody what's your utility function, or even if you say, let's take a particular utility function, give me your risk aversion coefficient, they say, we don't know what you're talking about. Okay, so we've sort of go away from utility maximization, because if you ask somebody what their goals are and with what probability and we tell them we're going to maximize the probability getting their goals, then the only thing that the investor has to worry about is, coming up with the set of goals and prioritizing them. But to keep things simple right now, we'll start with a single goal G. And what we want to do is at some horizon capital T, we want to maximize the probability that we will exceed that goal. That is, the portfolio value will exceed that goal. And we're going to hold a set of assets at time 0, time 1, all the way out to time T minus 1, so that at time T we get. So it's dynamically changing the portfolio over time. And we want to make sure that all these combinations of assets or portfolios that we put together are sitting on the efficient frontier over time as well. Okay, so that's basically the approach. So we discretize everything. We have a bunch of time steps. Just to keep things simple, just think of them as years. So every year we rebalance the portfolio. And there's a certain set of wealth values. So we're going to have a big grid of wealth values from some minimum to maximum. Okay. And then the portfolios are going to be all on the efficient frontier, which means we're going to pick a low level of return, that is low risk portfolios, and a very high level of return with high risk portfolios. And then in between them, there's a whole collection of portfolios on the efficient frontier that we can pick. So just to fix ideas again, just think that we're going to take 15 different portfolios, and every year we're going to rebalance into one of those. Okay, now how do we do this? This is just standard dynamic programming, so there's nothing really difficult over here. It's difficult in an engineering sense to make this run fast. If you code it in a normal way, it'll take 15 minutes to solve this problem because it's a pretty extensively large problem. And so we've done a lot of optimizations to bring that down to a few seconds, but otherwise, it's mathematically not very complicated. So if you think about working backwards, the first thing you do is go to the horizon and look at your wealth level. If you're below the goal, then you basically get 0 because the probability of getting to your goal now is 0. And if you're above the goal, at the end, you've made the goal, so the probability of getting to the goal is 1. Okay, so you fit these in here. Then you're going to roll backwards each period, and you're going to work out the expected probability of reaching your goal at 1 year to the horizon, 2 years to the horizon, and so on. And I'll go through that in some detail right now. There's no utility function, okay, because we know that it's hard to pick those. But the classic ones are, what you're familiar with in economics, and people use them still, even though it's very hard to have investors sort of understand what's going on with that. Okay, so let's just go to the single goal case. I just want to show you the technology and really bare bones. So suppose we are at year 10, which is the final horizon. Okay, so we're right at the end, and then we have a grid of wealth values, which are very, very, very sparse, just 3 levels, 40, 90, and 140. Okay, so we define a grid like that. We have a goal, where we basically want to reach that goal of 80. And we have only two possible portfolio choices. Okay, so we're looking at a very simple problem where you can either choose one portfolio or the other every year when you rebalance. And we're only going to look at time 9 just to see what happens working backwards at time 9. And okay, so here's my grid, 3 wealth values. This is T10 and time 9 here. And at time, if the cost of the goal is 80, that means to get that goal, let's say my goal was to buy a car or something, and so if it was 80, then I reach my goal at these two levels of wealth. So my value function, the probability of meeting my goal is 1 and 1 here, and then at 40, I can't get to my goal. So basically my value function is 0. Okay, they're all very simple. Now at this node here at time 9, where my wealth is 90, I have two choices. I can either put it in this portfolio, which has a 70%, 10%, and 20% chance of going to these levels of wealth, that is 140, 90, and 40. Or I can choose the second portfolio, which has the probability of 25% going to one, your wealth can grow to 25%, 65% chance of remaining at 90, and 10% chance of dropping to 40. So which portfolio should I hold over here? The first one or the second one? It's easy to make that choice because all I'm going to do is work out the expected, value function at this node. And so it's 70% into 1 plus 10% into 1, 20% into 0, and I'll get the expected 0.8. So the value function under that circumstance will be 0.8. If I do the second portfolio, then it'll be 0.9. So I'm going to choose portfolio 2 over here. Okay, so logically, this is really trivial. I'm just going to choose between these two portfolios and I work out the expected value. I see 0.9 is better. So I know over here my decision is choose portfolio 2. And then I do the same and I replace the value here, 0.9. So when I get here, under the optimal strategy of choosing portfolio 2, the probability that I'll meet my goal is 90% now. Okay, and it's the maximized probability of reaching my goal. Likewise, let's assume I did the same thing over here, and you can work those out and check them if you like. I base with different probability vectors, obviously. So this is sort of just an example, and I'll get a value function that's slightly higher here, which makes sense. At a higher level of wealth, I should have a higher probability of reaching my goal. At a lower level of wealth, I should have a low probability of reaching my final goal of 80, and I have this here. Okay, so that's how it's going to work backwards. So once I've done that, then I can go back to period 8 and work backwards. But at each of these nodes, I will know which portfolio I'm using and what the probability of reaching my goal is. And that's it. That's the solution technique. And it turns out it's really easy to do this. Okay, so any of you can code this as a homework problem or give it to your students if you like. It's kind of a good exercise to understand the process. Okay, so now more formally, what we're really doing is solving dynamic programming using the Bellman approach. So the Bellman approach basically says, take the value function at time t plus 1, which is based on the wealth level at time t plus 1, multiplied by the probability of transitioning from a node WIT at time t to WJ at time t plus 1. That probably gives you the conditional transition probability over here. And sum it over all these wealth levels, and you're done. Okay, and now what I'm going to do here is I'm going to choose the maximum portfolio. So it's basically mu, because once I choose which level of mean I want on the efficient frontier, I basically define my portfolio. So I just need to pick that. Okay. Now, how do I get these transition probabilities? I use the geometric Brownian motion in this case, but you can choose any sort of stochastic process to define those probabilities. And it's very easy to invert that equation with the normal PDF here to get the probability of conditionally moving from WIT to WJ to node J. So it's node I at time t to node J at time t plus 1. Okay, so there's a whole stack of these probabilities conditioned also on which portfolio you chose. Right, I showed you two portfolios where two different probability sets. We're going to actually use 15 in the real example, and 15 seems to be more than enough in most practical applications. Now, obviously, this won't add up exactly to 1 because we're doing it discretely. So we just normalize everything to make sure all the probabilities add up to 1. Right, but there's nothing special going on there. Now, once you've done this, you've seen the backward recursion approach. I went backwards the whole way, and I get to time 0 where I know exactly what the probability with how much money I have today of reaching my goal is going to be. I then go forwards on the grid, because what I want to do is I want to take the wealth, the probability of being at a particular node at time t, use the same transition probabilities to actually work out what the probability, unconditional probability of reaching every wealth level at every point in time in the future is. So 1 year out, I can give you the distribution of probabilities of being at different levels of wealth, 2 years out, 3 years out, and so on, under the optimal strategy. So we work backwards for the optimal strategy. We work forwards to get the unconditional distributions of reaching all these different wealth levels at different horizons. So it's a complete solution, and it requires one pass backwards, one pass forwards. Okay. You can easily accommodate additional cash flows. Okay, so if your cash flow is greater than 0, then it means you're putting money in. So you could say that I'm going to save $2,000 every month and put it in, and it keeps getting added in. Or you can have withdrawals along the way because goals are going to be taken. Okay. Anyway, so that's how it works. And I'm just going to show you an example. This is a very standard example because target date funds in the US use these 3 asset classes. And so if you look at anybody's target date funds, Vanguard, Fidelity, or whoever it is, they basically use these 3 asset classes. And over the 20-year period, this is sort of pretty standard return you get, and the covariance of returns is here. Okay, so that's just historical data, nothing special done there. You throw that into the Markowitz mean variance optimizer, and you get this efficient frontier. You can see that this is pretty standard. Usually investors go from about 5% to about 9%. These are not, big investors taking a lot of risk. And risk levels go from about 4% standard deviation to about 20% standard deviation, which is a little bit more than the S&P 500 risk levels. So that's the range. So it's not aggressive portfolios. So getting to goals is not necessarily easy with this set of asset classes because they don't necessarily, take a lot of risk. Okay, so we're going to just take this efficient frontier and take this portfolio at the top, the portfolio here at the bottom, and then 13 other portfolios in between. So we basically have a range of 15 portfolios we want to choose from. That means that every node on that grid, we're going to be optimally searching for the best portfolio amongst 15 portfolios. Okay, so it's computationally pretty heavy because you're going to have to do this for every point in time at every node on the grid and for every of the 15 portfolio choices. Okay, so like I said, you can work forwards and get the distribution of wealth. This is actually 1 minus the cumulative probability of getting to a particular level of wealth. So if I start with $100, you can see 1 year out, this blue line gives me the distribution. So the probability of being over like 125 is 20%. The probability of being over 100 is about 66%, and so on. And then we are really interested in the 10-year horizon, where the goal was, let's say, 200. We're starting with 100 and the goal is 200. You can see the kink over here because, above 200, you reach your goal, and below 200, you don't reach your goal. And so the probability of reaching your goal of 200 after 10 years is about 2/3. Okay, under that efficient frontier that we had before, and 15 portfolios. So let's take a little more of a standard problem. This is very classic in the US, actually. People reach age 50 and then suddenly wake up and say, now, retirement is coming, and, my health is not so good, and they start getting worried about stuff. And usually they don't have too much saved, especially in the US, where everybody just spends like crazy. So let's say you have only $100,000, in your retirement portfolio, and you're 50 years old. So let's say you're going to work till 65. So you're going to keep earning till 65 and putting savings aside. So let's say you contribute $15,000 a year in savings. But what you want is, once you retire, then from age 66 to 80, you want to withdraw 50,000 inflation adjusted, and the inflation rate is 3%. All right, so 16 years from now, you're going to be withdrawing 50,000 into 1.03 to the power t all the way out for the next 15 years. Okay, so assuming that from age 66 to 80, you want to withdraw, and the goal is to do so without getting bankrupt. All right, so now at this point in time, most people in the US are being, if you go with these financial planners, they'll put you in these target date funds, which will slowly, reduce risk over time with your age. And we want to see how well does our strategy perform versus the target date fund. So this is the asset allocation by target date funds amongst those 3 asset classes. So if you're 50 years old, they'll do more stocks. And then when you get to 70 years old, you can see it's mostly bonds. And so risk slowly comes off as you use a target date fund strategy. So we're going to ask this question, that what's the probability that you will be able to withdraw 50,000? You're going to put 15,000 in every year for 15 years. And then for the next 15 years, you're going to take 50,000 out, actually. Okay, hopefully your portfolio is grown enough, inflation adjusted. And what's the probability that this target date fund strategy, which people are normally in, will actually achieve that? It turns out if you're putting 15,000 in every year, the chance that the target date fund will keep you solvent till age 80 is only 27%. You're going to run out of money with that, almost 73% probability. If the goal-based algorithm will actually make it with 60%. So this is a massive difference. And the reason is very, very simple. The target date fund is not optimizing anything. It's just decided your strategy, and it's not really optimizing your goals at all. It's in fact a time-dependent strategy. It just says if you're this age, you get this portfolio. So it doesn't look at whether you're on track to the goal or not on track to the goal, because ideally what you want is if your portfolio is not performing that well in the early years, you want to take a little bit more risk optimally to try and catch up. It's like you're going for dinner and you're running late, you'll drive a little bit faster without driving too risky. And if you're early, you tend to drive a little slower because you don't want to just get there too early, or and so on. So, or you don't want to risk the chance of having an accident. And so, the goal-based algorithm actually does that automatically, and you get much better outcomes with this. Okay. Obviously, if you're able to put in a lot more money every year, then it doesn't really matter that much, and the difference between the two portfolio strategies becomes much less. But you can see that it's more than double the chance of actually staying solvent through that period. So this was actually, we expected our strategy to do better because we were actually doing something more optimal, but we were actually completely surprised by how much better it does. This was completely, unexpected. Okay, so the fourth thing, the last thing I want to talk about is multiple goals. I showed you what to do with one goal. Now let's talk about multiple goals. Okay. So what we need is the amount we have to spend for each goal, some forecast of that. So if you want to, buy a new car, you got to put that amount in. But we also want to be able to prioritize the goals. So we are not using utility functions. We're just saying utility is a weight that you put on the goals, so that if you have multiple goals and the algorithm needs to trade off one goal versus another because you can't do both, then it'll sort of pick the one with the higher utility and so on. Okay. So that's really what the investor does, and we have tools that help them sort of, constantly reprioritize those as well. Okay, so Bellman equation is the same, nothing changes there. We're going to work backwards. Forwards equation remains the same, nothing changed there as well. And we can work out with the forwards equation the probability that each goal is attained. Okay, so we basically translate it back. So the main thing is utilities for each goal. Investors have to specify what they are, so that we can weight all the different goals that they might have, and that's very important. Okay, so here's a very simple example just to get your sort of basic version, and then we'll talk about the complicated one. So again, we have time t equals 10, same three wealth values. The goal is $80, and at t equals 9, we have another goal. So multiple goals, which is a $50 goal with a utility of 0.05. So notice the last goal has a utility of 1. This says 0.05. So clearly this goal is not as important as the last one. Same two portfolios as before, and we'll have two stages. Okay, so I'm just going to show you the thing working as well. Same grid as before, identical. We know the answer to this one, 0.9. Done that. We have those also from before. So this is where we stopped last time. Now we have at time 9 another goal that we want to meet. So here's the trade-off. We can spend $50 on this goal and pick up this utility or this amount of sort of benefit, which is a value function. Okay, here the value function is a utility of 1, so we got 1, 1, and 0. We could have made this 100, and this would be 100, 100, and 0 as well. Okay, so this is just the amount you choose for the utility here. Now here we have to choose. Should we spend $50 and take this, and then hope to get this as well in the last period? But obviously you spend 50 here, then the portfolio drops by 50 and it reduces the chances of getting the one later. And so we have to make these decisions carefully. So the first thing is here. If we are this node 40, we can't take this goal anyway. So this might have been buy a car for 50,000 and you just can't get it. So forget it, it doesn't help. And so the utility is just the same as this one. So first step was take these utilities, discount them back and get the value functions here. And here I can't take this goal, so the value function is just the same. So all this is happening at time 9, okay, in 2 steps. One is get the discounted values and then check whether, so if you've taken the binomial tree stuff for pricing American options, this is kind of the way you go about it, whether you want to exercise the option to take that goal or not. Now let's go over here. I have enough money to take that goal. Okay, so I have 2 choices. Don't take the goal, in which case my value function is 0.9, remains at 0.9, or I take the goal, which is I spend 50 and I get 0.05. But if I spend 50, then I'm no more at this node because I will drop down to here because I'll actually have a wealth of 40 now. So let's take this value function of 0.875 plus this 0.05, that's 0.925, correct? So if I take this goal and pay 50, then this node here will have a value function of 0.925. If I don't take the goal, it has a value function of 0.9. So I should take the goal here. Okay, so I made my choice here to take the goal. Last node up here, intuition might tell you, hey, look, if you're going to take the goal at 90, obviously you can take it at 140. But that's not always the case. Let's work it out. If I take this 50 here, okay, I basically will get drop down from 140 to 90. That's 0.9 plus this 0.95. But I'm already at 0.975 here. And so I actually don't take the goal here. Okay, so at each node, we can make this decision of taking a goal or not taking a goal, and so on. So that's the basic, very simple example, but we might have more complicated examples as well. Okay, so let's take an example here where we have a 10-year horizon. The cost of the goal at 10 years is 150. The cost of the goal at 5 years is 100. So there are two goals, one at 5 years, one at 10 years. And then we try all different combinations of utility. So if I make them equal, then obviously the first goal, becomes the probability of getting to it is much higher than getting to the second goal, because if you have the chance of getting the first goal, you just take it, okay, and collect it because the utilities are the same, right? And this is in fact cheaper. So if I'm just going to take the first goal every time and then worry about getting the second one. But if the first goal has a lower utility than this one, then obviously, even if I reach 5 years and I have enough money to take the first goal, I may not want to take it because it might reduce the chance of getting the second one, which has a much higher utility. And in that case, you can see here, I'm going to the algorithm automatically is going to favor the second goal, which is going to get to the probability of 92%, and this one much less. And these don't add up to 1 because there's some chance you won't get either of the goals. Okay. Now you can plot that on a grid and see. So we have 15 portfolios going from portfolio 0 to portfolio number 14. So the darker the portfolio, the higher risk, higher return portfolio. The lighter the portfolio, the lower risk, lower return. You start out over here, you take the high risk portfolio and start off. It tells you optimally to do that. And then if your wealth grows, you keep taking high risk. If your wealth falls, you dial down the risk because you want to make sure you get the first goal, which is at 100. And so, if your wealth is above 100, when you get to year 5, you will take that first goal and then move on. So once you've taken it, then you can jack up the risk again to try and reach the second goal. And that's really what's happening. Okay, so these colors tell you the entire strategy at time 0 once and for all. We can do more complicated versions of this. But one of the complications is that on the same date, you have multiple goals. Right now, I showed you a case where on 5-year and 10-year, you have one goal each. But you could have on one date, 3 goals. And then you could also have partial goals. So for example, this is one goal where you have to pay $7,000 and get a utility of 10. At the same time, you have another goal, but it has 2 levels. So think of this as a car where you can buy a cheap car or an expensive car, $10,000 or $20,000. The expensive car gives you much more, happiness than the cheaper car. And so the algorithm needs to decide, what you can afford and what you'll take at that time. And then this could be another goal, which is like, holiday or something, and you have all sorts of, or your kid's wedding, and you're deciding, different levels of expenditure at that time. Now, if you combine these, this has 2 options, take the goal or not. This has 3 options, 2 ways to take the goal and 1 not, and then 5 options over here. So you already have 30 combinations. If you put them together, you get all these sets. That means now my algorithm has to first say, should I take this? What's the utility? Should I take this? What's the utility? Last time, it was just one goal, and you saw me making that decision. But now I have to do it across all 30 combinations. So I'm going to reduce the number of combinations, obviously, because notice this one is dominated by this one. Here, I can pay 10,000, get a utility of 4. Here, I can pay 10,000, get a utility of 10. So clearly, I get rid of this. So I can remove all the dominated cases by cost, and I can remove all the dominated cases by utility, and I end up with basically 11 combinations. Still a large number of combinations to check at that particular point in time. All right, so notice the scale of this problem is growing. There's a huge wealth grid, which could have 1,000 values of wealth. You could have many, many years. And then at every node on that grid, I have to check all these combinations of goal taking for each and every combination of portfolio. Can I have 15 portfolios? There's a huge amount of computation that has to be done looking backwards. So I'm going to show you the big problem. Let's say you have a couple, both of them are 35 years old. They have a 5-year-old kid, and they're looking to live till, or at least manage their money out to age 95. So a 60-year financial plan. And it turns out they have 301 full and partial goals spread over time. And these goals look like this. So we've separated the goals into categories, 1, 2, 3, 4. These are top tier goals, which are very important: mortgage, long-term care insurance, medical expenses, everyday expenses. These ones, this is the cost, this is the years over which the goal will exist. So the mortgage, for example, is going to have a 10,000 payment for the next 25 years. Property tax is going to be 6,000 over the next 60 years, and so on. And we also add inflation to it, so we can work out what the cash outflows will be over time. And then you have these other things: orthodontics, college, cars, remodel, wedding, high school, so on and so forth. Okay, but they're going down, the priority gets less and less. Same 15 portfolio allocations, geometric ground motion. We've done, the paper actually has a thing with the T distribution as well. We have a grid of wealth that's up to 1,200 wealth values, which go between 0 and 18 million. And then the initial starting portfolio is 100,000. That's all they've saved so far. They have a salary coming in of 70,000. So at every time point, they have some salary coming in, increasing at 4%. And the last, they end with a $265,000 salary. Then at time 35, so 35 plus 35, at 70 years old, they start collecting Social Security, which gives them 120,000 a year, growing again at 3%. And we actually solved this entire problem in about 17 seconds. Okay, so there's a lot of parallelization, compilation of the code, and so on, various computer science tricks to get this to work. All right, utilities. So the customer had that table of goals. Now the investor has to say these utility values. Okay, so what they're going to do obviously is, in practice, we have a default set of these. And I'll show you a trick to actually make this even easier for the investor. But the idea here is to put very large numbers here so that these goals get prioritized over the ones below down. And you can see the utility values are smaller and smaller as you go down. We run the entire algorithm backwards. 17 seconds later, we run it forwards as well. And we get the probabilities of reaching each of these goals worked out. So we can tell the investor, you set up your utilities, you set up your goals, we run the algorithm, and all your top tier goals have very high probabilities. Okay, your everyday expenses, you live at a level of 60,000 a year versus 50,000. So this is the partial. So, one of these gets picked every year. And so there's a 99.7% chance that you will make your 60,000 every year of household expenditures. And there's only a really almost zero chance that you'll have to drop it down to 50,000. And then you can see some of the others. Now, college, for example, there are 4 years of college here. And for the 4 years, some of them, the lowest has 76% and the highest has 82%. So there's a range out here. And so if the investor suddenly says, I don't like this, I value my kids' education more, can we push this up to like 90%? And you say, okay, change this number, push it up a little bit and rerun the algorithm. What will happen is obviously these properties will go up, but some of the other properties will obviously come down. Nothing comes for free, right? So if you push up the utility of one, the algorithm will favor that goal and disfavor some of the other goals. Okay, but you can quickly change utilities and recompute it. You can ask questions like, what if I, instead of starting with 100,000, I start with something more, or I put in more every year, and so on. Okay, now target date funds cannot prioritize goals. They're just like doing, whatever your age is, you get it. So one size fits all. We actually ran this algorithm with target date funds to see what is the chance of attaining all the goals. There's only a 4% chance, 8% chance of attaining the first 16 years of goals. And in our case, we can basically get very high probability. So I'm going to show you a good path. So this is a case, one sample path where, the markets did well and everything. And we just put all the goals here. So it's based on this previous table, okay, same goals, but you can look and see, so green, for example, is the everyday expenses. And you can see you're getting all those green values. They're growing with inflation over time as well. So you can see the amounts. You can see the 4 years of college over here. Pretty much you get to send your kid to college and pay for it. You can see cars are up here, sorry, the cars, yeah, you can see the cars are picked off every 5 years. Actually, these are the blue ones down here. The remodel is over here. And you can also see the vacation trips coming, at these periods. So they're making all, here. Now, obviously, if it went bad, also they start with 100,000, the portfolio grows, then obviously you start retiring and you're drawing down your balances. But even when you die, let's say at age 95, you're leaving $2 million to your heirs. Now, we can also look at a sample path that was bad. Obviously, we do it across all paths because we're working the whole problem backwards. But now we're just showing what happens along a single path. So if I do a bad path, you go all the way up here, but then, at the end, you only leave like a couple of 100,000 for your kids. And you can see that all those vacation trips and all those things are getting lopped off, but most of the major goals are actually getting met. Okay, so you can flip back and forth quickly to see the change in the bars, and you can see the haircuts at the top where you had to give up some of your goals because this was a situation where the market kind of didn't do all that well.
So these different paths are based on your models, which was GBWM model, right?
Yeah, so what we do is we randomly generate a portfolio. We hold the optimal portfolio, we generally generate a random return, and then we obviously randomly migrate to another path on the solution grid, another point of the solution grid. We know already what portfolio you should hold there and which goals you will take. So we keep track of which goals you were taking at all those points. So setting this up actually in code is quite messy. It's a huge, big, algorithm, but it's nice because you can actually do a lot better than target date funds. And in fact, I literally took my money out of target date funds and started, allocating them this way because there's no comparison. It's totally better. So that was really, I'm going to do a couple more things in a couple of minutes and leave some time. So just want to give you a summary at this point. Really what we are doing is not optimizing performance against benchmarks. Okay, because that's what people do. It's very short term. Everybody looks at my 1 year return against the S&P, for example, and says, adjust my portfolio. That really has nothing to do with goals, and it really means nothing for the long-term sort of satisfaction of the investor. We will maximize the probability that investors reach their goals across multiple goals. I showed you also the mathematical logic, why this is completely consistent with mean variance optimization. We didn't throw that out. And so, it sits on top of the existing approaches that people have because people basically have some kind of mean variance optimizer already in place. We don't even need that. You can just tell us these are the 15 or 30 portfolios that are candidates every time that we want to use, and we'll just take the mean and sigma of that and literally choose it. Okay, so one way to do this is not even worry about Markowitz. Just say, you give me your favorite portfolios and I'll tell you every year which one to rebalance into and do that. So we've done a lot of extensions to this, okay, and with taxes and so on and so forth. Now, there's a big literature on mental accounting. So if you go to a robo-advising platform, you'll see they'll ask you for goals. They'll treat each goal as separate. They put them in a separate account and then they manage that. Now, that's sort of suboptimal, because you're managing, you're optimizing separate portfolios, which is never going to be as good as putting it all together in one portfolio and optimizing the whole thing. Okay, so it's not glide path investing, which is what target date funds do. In fact, we call it glide surface because we have wealth and time as decision variables in the state space. We don't only have time, which is what the target date funds are using. It's not one size fits all. Okay, you can be at the same age as somebody and have a very different portfolio because your goals are different. We've adapted multiple and partial goals, as you've seen. We have extended this to dynamic regime switching, which I mentioned earlier in response to that question. So that paper is on SSRN as well, and do download and read it. We have another paper on SSRN, which actually tax optimizes this. This is a much harder problem. Where you actually, in the US at least, I think in India, the taxes are somewhat simpler, but in the US, you can have two types of retirement accounts, TDA, where you pay taxes when you take the money out, a Roth, where you pay taxes when you put the money in, and you can put money, across both those accounts. And then you have your regular taxable account, which is not your retirement account. So you basically have, and that can have a stock account and a bond component, which are taxed differently. So we actually have 4 different types of accounts in the US. And then you want to do all the stuff I showed you, but optimally also decide how much to put in each of those 4 accounts to be tax efficient. Okay, so that's a much harder problem and much messier. And so we've solved that. There's a paper that actually just got accepted. So that's also on SSR, and if you want to look at managing taxes. Okay, so those we can have, we can optimize this to choose the target probabilities as well. Okay, so this is sort of, Brunel was sort of the father of goal-based wealth management, and he sort of talked about those 4 categories, and we just adopted what he had. He calls them dreams, wishes, wants, and needs. Okay, so the needs are going to be the ones we put high utility, the wants are going to be slightly less, and so on. Okay, I just want to show you one more thing we've done. Before, basically what we said was that you wanted to kind of specify your utilities, and then you will run the algorithm and see whether the probability is acceptable to you or not. The other way to do this, to say, I have 2 goals, let's say, just to keep it simple, goal 1 and goal 2, and I want to know what the best probability frontier looks like. So I run the algorithm for different utility levels of goal 1 and goal 2. It traces out the probabilities under those different utility levels, the best probabilities under those utility levels, and gives me a new curve. So this is a completely new concept. We call it the efficient probability frontier. And it tells me the best I can do with my starting money and the asset classes I'm willing to choose, or the model portfolios I'm willing to choose. That means I could choose a portfolio here or a portfolio here, let's say, which has a 60% chance of getting to probability goal 1 and a 45% chance of getting to goal 2. Or I could choose a portfolio here, which has a 20% chance of goal 1 and an 80% chance of goal 2, and so on. So this entire portfolio frontier is what I want. Now, if the customer comes and says, hey, I want a 50-50, then you're going to say, he's over here, right? Something like this at this point. And we say, hey, we can do better than that. We can move you up to the frontier here, actually. Okay, so they can actually move up to the frontier as well. So if they have their target probability here, we can get up here. So we basically, the customer, instead of giving utilities, just says, I want these target probabilities, and we basically work it out to see whether you can do better than that or not. And we call this the goal probability frontier. In 3 dimensions, it starts looking like this: goal 1, goal 2, and goal 3. You get a surface, the goal probability surface, and then obviously in higher dimensions you get a hypersurface and so on. All right, so that's sort of the whole framework. And the parts I haven't shown you are the regime part and the tax efficiency part, which is something that overlays on top of all this as well. And we're doing some more stuff which I can't talk about right now, but hopefully will get published. One of the nice things is that we are publishing everything and hoping to inform the community as well. Okay, so we have a little bit of time for questions, so I'll just leave the summary up. There was some in the chat. Let me see if there's anything in the chat. So you've used, so Bharti is asking, you've used the geometric motion, how do you for long term? Yeah, so I think I answered that one. Your variance would be a constant for, yes, so that I think I answered that. Yes, the variance and expected return is definitely, we've got that extension with the regimes as well. But you could probably try different models as well. There's no reason to not have time varying variance, because the only thing that would change in the model, in fact, let me just go there. The only thing that would change in the model would be when you have the grid and you're transitioning. So these transition probabilities that we have, they can be time varying. That is, at every node, the mean and the volatility could be a function of both the node, the level of wealth, and the time. And so you can actually set this up to be completely time varying as well. The only thing is, then you're making some other assumptions as to how it works. So what most of the asset management companies do is they basically have a 10 to 15 year horizon. They call that a CME, or capital market expectations. And they put that in. Now, every year they change those. So it's not like they don't change. And one option is to resolve the problem every year. And usually that's not necessary. You don't have to do that. But you should expect that, every 5 to 10 years, this problem will get resolved because the world might have completely changed. So for example, with the pandemic, and trade wars that Trump started, a lot of the capital market expectations of all the money management companies completely changed. And so there was a lot of period of, recalibrate. Now, this is not a problem that affects this particular technology. It affects every asset management technology that you might have, that you have to update your parameters over time. Other things can happen. We can't predict that this 35-year-old couple is going to remain married for the whole 60 years. They might get divorced and everything changes. They might have more or less kids than they expected and planned for originally. So those can change as well. So it turns out that if you make small changes in the goal set, you can migrate, across your efficient frontier a little bit and have a completely new problem that you solve, but it doesn't change things too dramatically. But obviously, if you get divorced or something, the whole thing can completely change and then it makes much more sense to just start the problem over and resolve it. Okay. Siddhant is asking if we can share the links to the 2 to 3 research papers. Let me just tell you that they're actually available on my webpage and in SSR.
I'll share those links.
Yeah, if you can share those later also. Yeah. But if you just go to ssrn.com, you should be fine. So let me just, if you just go to I don't know if everybody is looking at SSRN. Definitely the academics would be, but just go to ssrn.com and all the papers.
I think there's one more question by Saurabh Majumdar. With respect to the first part, is it efficient frontier regression with a black determined model? It would be interesting to find that out.
Okay. So did I miss that? So the question is, can you use the black Letterman model? Is that the question?
Is the efficient frontier equation known for the black Letterman model?
Yeah, so
it would be interesting to find that out.
Right. So the black Letterman is actually a way of getting the inputs, the correct inputs, the mean vector and the covariance matrix for the Markowitz problem. But it could also be used for problems that are not necessarily only mean variance cognizant. You might be worried about skewness as well, for example. And that's why this framework is kind of nice, because I don't really care about what if the model is for generating the efficient frontier. That could be anything. Because what we really want is a set of portfolios. So instead of using the 15 portfolios based on my efficient frontier, if you have 15 portfolios or 25 portfolios based on the black Letterman technology that you would like to consider, or any other technology that you might have, that just becomes an input to the model. Okay, the cute closed form that I showed you right at the beginning was just sort of the starting point, where we were actually able to get a closed form addition to the Markowitz problem. But the general purpose multi-goal model framework is completely agnostic to which portfolios you want to use. You want to use inefficient portfolios, fine, we'll use that too. If you just decide not to run any optimization and just say these are the 15 portfolios or 30 portfolios that we want you to decide to rebalance between, sure, that's fine as well. So black Letterman is not necessarily the only way to go here. You can choose anything else you like. It's a totally general framework.
I have a question of my own here. So with this particular problem that you have posted, this is not just a finance question, it is more of an optimization question also, right?
Right.
Because in order to solve that, as you mentioned, as you increase the number of portfolios.
Oh, sorry, one sec. I'll just mute this thing. My other meeting is starting. So hang on. I don't know where it is though. Oh, okay. Sorry about that, Anirban.
Yeah, sure. So anything specific that you take to overcome the optimization challenges? Any sort of modifications over here?
Yeah, so there is, we've done a lot of smart stuff to actually make this run faster. So one of the things I showed you, one of the ways to have done the backward recursion would be at every node to take a portfolio and the goal combination and do that. So I basically, let's say K times L. We've kind of described this in the paper. What we've done is made it K plus L. We first solve once only for the best portfolio, then we decide which goals get taken. It turns out they are identical. So you can actually unwrap. So if you have 30 goals at a node and 15 portfolios, that's 450 combinations. Instead of that, we do 30 plus 15 and it converges. So there's a nice result there. There's a paper, we didn't put that in the paper actually initially. It was sort of a little bit of a secret sauce that we had done, and we didn't have it in there, but now we kind of put that. The second thing that really helps is we don't go node by node the way I showed you for the intuition. we actually do the entire vector of time points or wealth values, 1,200 wealth values and more, depending on the assets. We might have more than 1,200 if the volatility is higher. And we do it like one shot. So we actually multiplying tensors and not just doing there's no summations or anything. It's all done with tensors. And so the compute becomes a lot faster. And then on top of that, we've had to, do a lot of compilation on the fly and so on and so forth to not just run Python on R code, but actually run it in C. So that's what brings it down to 17 seconds. We get a lot of emails from people saying this is taking 15 minutes to run. What do you do? And I say, well, that's, first part is understanding the math and implementing a toy problem. And then after that, when you scale it, it just dies, until you sort of do this optimally. So yeah, so there's a lot of interesting optimization tricks here that I think are educative as well. So yeah.
So Anil is asking whether this kind.
Anil has, yes, I mean, absolutely. I mean, all you need is to, pick goals for investors in India and set up the table, and then obviously use assets that are from the Indian markets, to create portfolios. I wouldn't even worry about assets, just construct, 15 to 25 portfolios that you think investors would like to choose between, and you're up and running again. Yeah, it'll work anywhere. It's really a theoretical exercise, but then it's been implemented just to see how much better it does. And we had to beat validated target date funds, which we were surprised by how well it did, and that made it sort of popular. So there's a lot of companies now trying to do this. Our papers have been out for a couple of years now. The multiple goals one, in fact, just got accepted only like 2-3 weeks back. So it's also going to be out in the public domain. So yeah. Okay, I'm going to have to jump. I have another meeting starting. Sure. So
thank you.
Just want to thank you. Thank you for giving me the chance to speak to everyone, and hopefully, the papers will be useful.
Sure, it was a great experience for us also. Thank you for.
Thank you
for this particular. Thank you so much.
Bye.